Good morning, good afternoon, or good evening wherever you are from. Welcome back to a new episode of Daily Insights. Before we start, please subscribe to this channel and hit that bell icon. Without any further ado, let's get started. If you got your first job over a decade ago, you might remember that when you did well at work, you'd probably find an envelope with some cash on your desk. Or maybe you'd get some coupons that could be spent only at select places. You'd stuff it into your wallet and go out to spend it. It was a little cumbersome. And that's the problem the founders of Zaggle Prepaid Ocean Services saw back in 2011. They wanted to make the lives of employees simpler. And that of the company too. So they introduced cards that could do the hard work instead. But wait, Zaggle isn't a bank or an NBFC. Then how could it issue cards without a license? The trick is prepaid payment instruments or PPIs. Think of PPIs as a digital wallet or card that functions like a mini bank account. It could be a gift card that someone can top up with money. And the recipient of the card can use this stored money to make any purchase they want. And you don't need to be a bank to deal with PPIs. You can simply partner with them to get the ball rolling. And that's what Zaggle did for nearly 3 years. They went after improving the rewards and recognition market through these cards. Once they kind of had that in the bag, they turned to the next thing. Again, let's rewind our clocks by a decade. And you probably remember being issued paper coupons along with your monthly salary. You could use them to pay for food at the cafeteria. Or when you bought groceries. These expenses, up to a limit, could be claimed tax-free. But the bits of paper were a headache. You could easily misplace it and there would be no way out. So in 2016, Zaggle saw it as the next logical step. They'd launch a multi-wallet card along with Visa. Employees could use it online or offline. You could use it for meal vouchers, transport or some other thing. But it was simple. Zaggle's evolution as a fintech had begun. And they were in the right place at the right time, as the use of such prepaid cards began to explode. Then came the biggie, expense management. Say you had to travel to another city for an emergency meeting with a client, you might have had to swipe your own card. Then you would carefully collect the receipts, from the cup of coffee to the food to the hotels, and so on. And after you submit them, you would wait for a month for it to be reimbursed. The HR teams wouldn't track your expenses and give reimbursements. They wouldn't deal with paper receipts and verify each one of them. In large organizations, as the number of such requests rises, this process would be voluminous. The HR would rather avoid this mundane stuff and pay attention to more value-adding activities that can keep everyone engaged and motivated. And Zaggle saw the opportunity to expand its business in this domain too. It began to create software that would digitize this process and help companies manage overall expenses on a single dashboard. Zaggle could sell it for a subscription. And they even have software to manage employee rewards and recognition. It wasn't just about the cards. Now there's a bunch of other little stuff that they do too. That's the gist of diversified business segments that Zaggle dabbles in. And you see how they're a fintech plus SaaS company now. Anyway, that means Zaggle's revenue stream is quite diversified too. For starters, there is revenue from corporate clients for issuing reward points to their employees. These points that can be redeemed for stuff on the platform. Then there is the money they earn from banking partners whenever prepaid cards are swiped at offline or online points of sale, which is part of what they call program fees. They charge customers multiple fees for implementing the products. And they also earn a recurring subscription from the software they sell. And they have also started earning commissions from their value-added services. For instance, they have tied up with Five and Tata Securities for loans and wealth management products that employees can avail. So each time someone signs up, Zaggle gets paid. And it's a pretty hot market. Even globally, investors have been pouring billions of dollars into funding these expense management companies. As one CEO put it, it's part of a desire on the part of companies of all sizes and stages seeking to save money by managing their spends better. So Zaggle seems to be in quite a sweet spot. And by offering the full product suite, they have quickly amassed a customer base of over 2,400 customers split 75-25 between large corporates and small businesses. We say loyal since they seem to be pretty good so far with customer retention, as the churn rate is just about 1.5% in the past 3 years. Although we do have to mention here that it's a young company with even younger products. So the churn rate could go up in the future as competition gets more intense too. And maybe the company is aware of this. Maybe that's why nearly 70% of the 560 crore rupees IPO is an issue of new shares. The company will receive fresh funds, and the number one item on their agenda is to acquire new customers and retain existing ones, which probably means fresh spends on building out tech as well. Now all this sounds great, right? So, what's the catch in the IPO? What are the risks? Well, their borrowings have risen quite a bit. In March, the company raised 50 crores rupees as a loan from a venture company. Sure, part of the IPO proceeds will be used to repay this. But you have to wonder why a SaaS company resorted to debt, especially when it was so close to an IPO. Because the end result right now is that the company seems quite leveraged. The ratio of debt to equity is nearly 3 times. Then there is the fact that even though the revenues look good on paper, there is quite a bit of expenses too. The company bears cost when reward points are redeemed or gift cards are used. 63% of Zaggle's total expenses are attributed to this segment. And the end result is that the company makes just 20 crores rupees in profits on over 550 crores rupees of revenues. It's not that great of a net profit margin. Then there is the valuation. APE ratio of nearly 70 times is causing some discomfort among potential investors already. Many feel that the company does not have the track record to really command this premium. So, it might be a unique HR fintech company operating in a segment that's poised to grow. It might be a 12-year-old startup that's actually profitable. But there are some question marks you need to mull over before the IPO closes on 18 September. Until then, have a nice day. If you liked this episode, then give a thumbs up. Don't forget to subscribe to see more such insights. Thank you very much for tuning in, and I will see you in the next one.